Good to have you with us. This is Moneyline, time for Investments 101. Today we focus on bonds, the pros and the cons of these rather confusing investments. We all learn as we go along. We got to grips with the SA retail savings bonds, and it seems they're not as baffling as they first might seem.
Unlike many other assets, government bonds are generally seen as safe investments. A place where you can't lose money as your capital is guaranteed. Many investors go into bonds as a way to avoid the ups and downs of equity markets. A bond is used by both the private and public sector to raise money to either invest or spend on a specific project.
It's attractive because of the special features that it has. And I think one of the outstanding ones is that there is no commission that gets paid, and investors do not pay fees for the investment that they make, all because the money that you invest here is guaranteed and has the full faith of a government. So it is backed by the national government. You are not at risk of losing your money.
Traditionally, government bonds were mostly bought by banks, brokers, pension funds, and insurance companies. Then, in 2004, the finance minister introduced new bonds in the retail saving bond market to encourage South Africans to save. Government also wants to attract a different source of funding and not just rely on the investment community to fund its deficit and projects.
How this retail bond works is that you have your capital, which is the initial amount that you can invest for 1,000 rand, and from a minimum of 1,000 rand, and from there you earn interest, and then at the end of the term you get your capital back together with your interest.
Government's retail savings bonds have a relatively higher interest rate compared to other fixed income instruments like bank deposits or money market accounts. It's easy to access the bonds. You can buy them online at Pick n Pay, Score, or Boxer stores, or from the post office. Investors don't pay any charges nor commissions. But there are penalties should you withdraw your money before the investment term ends.
The consequence of withdrawing your money early is that you will lose the interest that you could have earned. You're supposed to invest at least for a minimum of 12 months. Then after that, your penalties will be less. But we do encourage that when people make a decision to invest in a particular term, they must just try to keep it until it matures.
There are also other risks. If interest rates suddenly increase in the short term, investors in RSA retail bonds may end up earning a lower rate of interest, as they are locked in at the rate for the term of the bond. Another argument against retail savings bonds is the risk associated with inflation, especially from those investors earning a monthly income from them. While the initial capital is guaranteed, the purchasing power of the income generated by retail savings bonds will be eroded over time. So, as with any investment, you have to first weigh up your own specific needs and personal circumstances. Only then should you decide where your hard-earned cash will work best for you.
All right, so time for some home truths now. The FNB House Price Index shows that prices climbed more than 21% between December 2007 and October of this year. Let's crunch the numbers for you and make sense of it. I'm joined by FNB property strategist, Mr. John Loos, who's with us on the show. John, good to have you with us. Good evening to you. Lots of very complicated numbers that I'm sure you're going to unpack for us. But just before we start crunching those numbers for a second, if you and I stand here right now and you're giving me some housing advice, is it good or bad news for people who want to buy houses right now?
I think the news is probably getting a little worse. That sounds a bit funny when, a lot of people think that the stronger the market, the better the time to buy. Not really so. The seasoned investors normally buy when there's blood on the streets. 2008, 2009, the really seasoned investors were snooping around the repo auctions. It was a really distressed situation. So the buying opportunity, as the market has been strengthening in recent years, and it has, It's becoming more of a seller's market. They can call the shots more. The house price inflation has picked up, although it's not what it was back in the boom years, certainly. And so the buying opportunity, I guess, on average has been deteriorating, or the opportunities have been getting less.
But it's not absolutely terrible, is the way you're basically suggesting the picture looks at the moment.
No, it's not terrible. It's single-digit house price inflation. It's not shooting through the roof as it was. In the boom years, our house price index measured 30-something% in year-on-year back in 2004. So at that stage, it was rapidly becoming less affordable for the aspirant buyer. It's not at that sort of pace now, but the market has been strengthening in recent, over the past 2-3 years.
One or two things I picked up in the report that I received a little bit earlier. And let me read this to you. Renewed month-on-month seasonally adjusted acceleration. Good heavens, it's a Monday night, 9 o'clock. What in the world does that mean?
Okay, we often quote the house price index in year-on-year terms, and that growth rate has been slowing, so you compare October with October a year ago. But a better way to determine more recent growth momentum is to look month to month. You seasonally adjust it statistically. It's a statistical technique you apply, and that has been accelerating. So while our year-on-year growth has just sort of taken a bit of a lull in the first half of the year, I think that economic contraction in the first quarter played some role, and the first interest rate hike. It seems like since about April, the market has been getting more confident again, maybe because the SARB hasn't moved very fast after January. Month to month, the inflation rate's starting to pick up again, and that, I think, in the coming few months will start translating into a year-on-year inflation rate that also starts to rise. So in short, in recent months, it has shown signs that the market is starting to strengthen further yet again.
It's this term, this re-acceleration, I think is the way that you put it as well. So now that you just mentioned what SARB is doing, the SA Reserve Bank, does this upward trend moving forward, even though the numbers are coming down for the moment, the trend suggests it's going to go up. Is that going to change suddenly if the Reserve Bank hits us with some bad news?
Well, I think it would. I think the slight drop-off in house price growth was due to that, and due to that January surprise, if you could call it that, rate hike. Our expectation is nothing for the rest of this year, but during the course of next year, a resumption of gradual interest rate hiking. Should that occur, I think what it would do, I think in the near term, the next few months, we'll have some sort of re-acceleration in house price growth, but staying in single digits, and then it could just start to slow yet again should interest rate hiking renew. But by and large, I think we're moving in the 5 to 10%, somewhere between 5 and 10% over the next few years, house price growth. I don't expect to see a boom, but just a pretty solid, well-balanced market.
Fairly safe to play within at the moment as well.
It's safe. It's not without risks, but we're not building up some property bubble, I don't believe. No. There's not a lot of irrational behavior and speculative behavior and all this craziness that we saw a decade ago. But certainly our economy is not without its risks. You've got a big current account deficit. If the foreign capital inflows aren't forthcoming, you can get rand shocks yet again. That can drive interest rates up more rapidly than expected. So with a big macroeconomic imbalance, you do have risks from the economy which can impact on the property market. Always difficult to predict that.
It's some wonderful free financial advice almost. And if I can ask you to keep this answer fairly brief, give me some good advice for someone watching at home right now. They're renting at the moment. Do you carry on renting? Do you look to buy? Are houses still the place to go to for new investors? And I realize I'm speaking to you from FNB, but is housing still the place to go to?
Look, I never. It's always a tough one. People want to buy a primary residence to live in because they're tired of being moved around by landlords or, having that uncertainty. So it's not just about timing the market. But what I do say to people is if you're wanting to buy now, first things, there's three certainties in life: death, taxes, and interest rates do go up. It's just a question of when and by how much. We're at relatively low interest rates by our standards. So I think it's prudent to make provision for a good few percentage points worth of rate hikes. Whether they happen or not, I don't know, but it's good to make provision for that. So in other words, buying well within your means. And then secondly, get to grips with the costs of running a house. There's more Eskom tariff hikes to come, or significant tariff hikes. Municipal rates have often been going up above inflation, and then there's water and sewage infrastructure, which is also creaking and will need funding at some stage soon. So there are costs related to housing which have been rising faster than CPI inflation. Make provision for that as well. And often because of that, smaller is better, whatever smaller means for people. So those are the type of things one has to consider in these rather toughish times.
And don't forget, Eskom will still charge you even though the lights are off, it seems, for a long period at a time as well. John, thank you very much indeed for coming in to speak to us. Some fantastic financial advice. And as well, if you are a potential homeowner, now you have it. You know how to play the game. Now, FNB property strategist John Loos himself joining us here on Moneyline, giving us the inside story on the bank's latest house pricing index here on eNCA. Well, this is your money guide. When we come back, our daily question and answer feature. What is it? Stay where you are. We'll tell you next.